The global energy landscape is undergoing a seismic shift, and well, the implications are far reaching. In 2025, a dramatic change occurred. U.S. crude oil exports to China have virtually disappeared. This isn't a temporary blip, it's a strategic realignment with potentially long-lasting consequences for the U.S. oil industry and the global balance of power. This article delves into the reasons behind this shift, the beneficiaries, and what it means for the future of energy markets. Unlike headline-grabbing trade wars, this shift happened quietly, driven by data. Following Beijing's imposition of a 10% tariff on American crude, Chinese refiners swiftly ceased booking U.S. barrels, even at discounted prices. Port loadings and customs records paint a clear picture. By mid-2025, shipments had plummeted to near zero. At its peak, the U.S. was exporting over 160,000 barrels per day to China, providing Gulf Coast producers with a crucial foothold in the world's largest oil market. This access is now gone, and no one is rushing to fill the void with U.S. oil. As U.S. oil faded from the picture, Chinese refiners wasted no time in securing alternative supplies. Russian barrels, already discounted due to sanctions, were the initial replacement. Saudi and Emirati crude followed, offering more stable pricing. In some instances, Iranian shipments were added, often through unofficial channels to bypass U.S. sanctions. These new supply lines were established quickly, backed by long-term deals, ensuring a seamless transition. The U.S. barrels were simply swapped out, demonstrating the adaptability of the global oil market. Perhaps the most significant aspect of this shift is the move away from U.S. dollar-denominated transactions. Many of the new long-term supply contracts are structured in yuan, not dollars. This locks in alternatives and reduces the relevance of U.S. oil in both price and payment terms. This isn't just about rerouting tankers, it's a fundamental reset of who China wants to do business with and under what terms. Restructured supply lines, especially those secured with long-term contracts, are difficult to reverse. So, China's pivot away from U.S. oil is driven by a desire for energy security and independence. By locking in multi-year deals with diverse suppliers, Chinese refiners ensure a steady flow of oil, regardless of geopolitical tensions. Payments in yuan provide stability, even if relations with the U.S. deteriorate further. China is also building up its strategic reserves with oil from these alternative suppliers, providing leverage in price negotiations and supply security during global shocks. This strategy aims to insulate China's energy supply from outside political pressure and reduce its exposure to American influence in a crisis. For American oil producers, the consequences are significant. China is unlikely to return as a major buyer anytime soon, given the new contracts and established trade routes. Gulf Coast terminals and pipelines built to serve Asian demand are now running below capacity. Companies are facing shrinking margins and increased competition in a crowded global market. The loss of China isn't just a dip in sales. It's a challenge to the entire export model built around Asian growth. While the United States loses ground, Iran has stepped in to supply more oil to China. Chinese refiners, especially the smaller private companies, have increased their purchases of Iranian crude through unofficial channels and a so-called shadow fleet of tankers. This strategy helps bypass U.S. sanctions and keeps Iranian oil flowing steadily into China. By the middle of 2025, estimates showed that China was importing over 1.7 million barrels of Iranian oil per day through these indirect routes. China's pivot here isn't just a bilateral story. It's having a ripple effect across the globe. India, for example, is increasing purchases from Russia, taking advantage of those discounted barrels. Southeast Asian refiners are adapting their buying strategies, looking at the same suppliers that now dominate China's import mix. Meanwhile, African oil exporters are facing increased competition from Russian and Middle Eastern barrels. All of this is changing the balance in global pricing and shipping lanes, signaling that America's former leverage in global oil is, well, no longer guaranteed. China's strategic shift away from U.S. oil is a wake-up call for American producers and policymakers. The world's largest oil buyer has built a system that doesn't rely on American barrels or the U.S. dollar, and that's reshaping energy deals, pricing, and power dynamics on a global scale. The question now is, can American oil producers find a way back into China's system, or is this shift permanent? The answer will depend on a combination of factors, including geopolitical developments, trade negotiations, and the ability of U.S. companies to adapt to a changing global energy landscape. What do you think? Let us know in the comments below.